On Tuesday afternoon, I was organizing our nationwide meetup in March, and my phone buzzed non-stop. It's all over the news and social media. Finally, Australia has cut the interest rates.
The interest rates have been cut by 0.25% to 4.1%, cut as broadly expected by the markets by 0.25% to 4.1%. So you can see here where the interest rates have moved to, down from 4.35 to 4.1%.
This is a real turning point for the nation in terms of what happens next.
Although the media, the experts, and the AUSPropertyStrategy all predicted a Tuesday rate cut, I was still excited when I saw the news. After nearly 4 years under pressure, the relief finally came. Many believe the rate cut will boost the economy and benefit the housing market, but it's not that simple. The rate cutting process might not play out as you expect, and its impact on real estate may not be as one-sided as what you see on various social platforms. After all, 2025 will bring numerous factors influencing Australia's property market. Hi, I'm Alex. Welcome to AUSPropertyStrategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Everyone already knows the news. The RBA announced it's lowering the official interest rate from 4.35% to 4.1%, a reduction of 0.25%. It's the first rate cut since the central bank maintained its highest rate for 15 months. Why cut rates? The central bank has two responsibilities. One, ensuring price stability. The RBA's goal is to keep the inflation within the 2 to 3% target range. The 2024 fourth quarter CPI data was just released and it's already dropped to 2.4%. Moreover, for the past 3 quarters, results have exceeded RBA expectations, meeting the bank's sustainability requirement for reducing inflation. Number 2, maintaining employment. Over the last 6 months, the unemployment rate has remained very steady at about 4%. These factors all justified the central bank's rate cut. Of course, there might also be pressure from the current federal Labor government seeking votes, as well as from other nations that have already cut their rates. The Federal Reserve's first rate cut was on the 18th of September 2024, while Australia followed on the 18th of February 2025, exactly 5 months later. Historically, Australia cut rates within 3 to 6 months after the Fed. It turned out to be accurate again. After the RBA announced the rate cut, the governor replied to the reporters at the press conference. The market expects a few more rate cuts till mid next year, specifically 3 more on top of today's cut. But whether we cut again will depend on the data. Right now, 3 more cuts might be overly optimistic. Those were her exact words. Interpret them as you will. At AUSPropertyStrategy, we always share the original source and then add our personal analysis. From my observation, regardless of political pressure behind the scenes, the governor insists on only cutting rates once the data meets the criteria. So I'll keep a close eye on the numbers. My guess is that 2 more rate cuts by mid next year are pretty likely. Rate cuts do stimulate housing. Once the central bank lowers rates, commercial banks follow suit, reducing both deposit and mortgage rates. For borrowers on variable rates, monthly repayments drop. For example, on a $1 million loan, a 0.25% cut translates to a $2,500 less per year. That's $208 less monthly. It's not huge, but it visibly reduces holding costs and eases pressure to sell. Prospective buyers also gain higher borrowing capacity, allowing them to spend more on the property they want, which boosts the market. Ultimately, however, prices are determined by supply and demand, influenced by policy support, immigration, land approvals, construction costs, unemployment rates, overall economic conditions, international trade, and even currency exchange rates. In the early stages of a rate cut cycle, the biggest impact is on lower-priced homes, where many buyers are first-home purchasers stretching their budgets or borrowing from relatives. As rates fall, they feel immediate relief, so cheaper second-hand properties and new development suburbs tend to react first, hitting up and pushing prices upward. Different cities and regions may respond at different speeds. Places like Sydney and Melbourne may initially slow their price decline, stabilize, then begin to rise, while Brisbane and Perth, already on an upward trend, are likely to keep climbing. Areas shown in darker colors on the map reflect more households carrying mortgages, typically middle-income neighborhoods and development suburbs. This will quickly reflect early rate cuts. For mid to high-end properties, initial reaction to rate cuts might be less dramatic, since buyers in that segment aren't swayed as much by a few $100s a month. Many pay cash and don't need mortgages. After multiple cuts, however, the mid to high-end market's response will become more pronounced. What should property investors do next after Australia has started a rate cut cycle? Number 1. Refinance. After the RBA's rate cut, the Big Four banks announced matching cuts within 10 minutes, showing how eager the industry is to lower rates. If you have a mortgage with one of the Big Four, check your variable rate to see if it's changed. If nothing happens by the end of February, contact your mortgage broker to request a better rate. If you deal directly with the bank, you have to call them to negotiate. If they still don't give you the best rate, consider switching banks. Australian commercial banks often offer their best deals to new customers. Those who've had loans for more than 2 years typically don't receive many perks, neither good rates nor cash-back offers. It's almost as if they punish existing customers. Why? First, if you use the mortgage broker, switching banks within 2 years will force them to refund their commission. So brokers generally want you to stay put and will treat you well for 2 years. Second, most bank lending staff move to different roles every 2 years. For various internal reasons, banks continuously chase new clients while ignoring the old ones. So unless your borrowing capacity is limited, consider switching your loan to another bank after 2 years just to get better benefits. Don't worry, every bank other than your current one would love to have you. Number 2, selling. If you're selling or planning to sell this year and you're not in a rush, you could wait. Overall, the 2025 market may slow at first and pick up later. If you already have a great investment opportunity and your property is in Melbourne or Sydney, you could sell now and immediately use those funds. But if you haven't found a new place to put your money, waiting till later in the year might make sense, as those markets could stabilize or even start to recover. For properties in Brisbane or Perth, unless you truly have to sell, don't. Long-term prospects look good. Although the price increase has been slowing in recent months, the rate cut should restart the upward momentum. Number 3, buying. If you plan to buy a primary residence this year, you can pretty much do it anytime, in any city. People typically hold their own homes for 10 to 20 years, long enough to ride out several market cycles. So entry timing isn't as critical. It's more important to consider transport, shopping, groceries, and school catchment. Focus on your personal needs first. If you're buying an investment property, timing matters a little more. In Greater Sydney or Melbourne, you can wait a bit because prices are still edging down. Perhaps by May to August, assuming 1 or 2 more rate cuts, you'll see improved market conditions. Then again, if you follow my advice and lose money or miss the perfect timing, don't blame me. AUSPropertyStrategy has been around for 4 years, witnessing 5 key market shifts. Luckily, I called each trend correctly, though not with precise timing. I believe in property as a long-term game because I don't think anyone can time the market perfectly every time. Sometimes you just get lucky, sometimes you don't. For those interested in Brisbane or Perth, go ahead and start looking now, no need to wait. In our previous AUSPropertyStrategy episode released on Saturday, we discussed Liberal leader Dutton's plan to prohibit overseas and temporary residents from purchasing existing Australian homes for 2 years. This proposal was included in his campaign brochure at the end of January this year. But the very next day, Sunday, the current Labour Housing Minister announced the same policy set to take effect on 1st of April this year, with not a single word changed from Dutton's original. It appears they just copied it for voters' appeal without shame. When the migrant community heard the news on Sunday, they got scared. Some said the housing market was done, others praised the Labour Party. Let's see what the Labour actually said. The policy was posted on the Treasury website. You can check the original text. It states from the 1st of April 2025, foreign investors, including temporary residents and foreign-owned companies, are prohibited from purchasing existing Australian properties for 2 years. If you look closely, it's exactly what Dutton proposed, copied word for word. To sum up, only Australian permanent residents and citizens may buy existing homes. Foreigners and temporary residents can only purchase off the plan or properties under construction. Note the wording, existing properties. We used to assume it meant second-hand homes, but consider one exception. Brand new developments that are already completed and ready for immediate occupation, yet have never been sold. Based on Labour's wording, I guess this kind of property will also be off-limits to foreign or temporary resident buyers. That likely cuts off the business of selling newly built apartments to international students. Perhaps that's not so bad. Fewer people get tricked. However, prices may face more downward pressure for apartments clustered near students' favorite inner city suburbs. Since buying isn't allowed, only renting, that could drive rents up. After the last episode, many people left comments predicting doom for the Australian property market. My verdict? The impact is negligible. The number tells us why. According to CoreLogic, Australia sold 530,000 properties in total in 2024. In 2023, only 1,800 completed properties were sold to temporary residents, 455 in Victoria, 403 in Queensland, and just 165 in New South Wales, making up only 0.34%. Many of these were apartments purchased by international students. If you still believe this policy alone will ruin the market, I suggest sticking with your money in the bank instead of real estate. Look at how the media environment flipped in 3 days. Sunday's overseas buyer ban triggered frenzy, some shouting a market crash. Then on Tuesday, a rate cut made headlines, others shouting the property market would skyrocket. Successful investors should have no emotions, only an analytical brain. Keep in mind that many property agents use these emotional waves on social media to their benefit. If you're easily swayed, don't blame them for tricking you. You just didn't watch AUSPropertyStrategy. If you've made it this far, please give me a thumbs up, subscribe and share this with your friends. Turn on the notification bell to watch new weekly videos. And have a good one. Bye.